Welcome to a journey into the world of investing, guided by one of its most successful practitioners, Peter Lynch. In his groundbreaking book, One Up on Wall Street, Lynch shatters the myth that you need to be a Wall Street insider or a financial genius to succeed in the stock market. His core message is both empowering and remarkably simple. The average investor, armed with common sense and a willingness to observe, possesses a significant advantage over the professionals. Lynch argues that we are constantly surrounded by potential investment opportunities. Think about it. The stores you shop at, the products you buy, the services you use, these are all businesses. By paying attention to what's thriving in your immediate environment, you can often identify promising companies long before professional analysts on Wall Street even notice them. This home field advantage is the cornerstone of his philosophy, allowing you to discover the next big thing right in your own backyard. So, how do you put this into practice? Lynch introduces several crucial concepts and strategies. The hunt for 10-baggers. This is perhaps Lynch's most famous term. A 10-bagger is a stock that increases tenfold in value, or even more. He illustrates how just a few of these in your portfolio can dramatically outperform years of smaller gains. He shares examples of now household names like Dunkin' Donuts, Walmart, and Toys R Us that were once overlooked opportunities, waiting for perceptive investors. The pursuit of 10-baggers isn't about risky bets. It's about identifying solid companies with strong growth potential early on. Tune out the noise. Focus on the long term. One of Lynch's most vital pieces of advice is to ignore the daily market fluctuations and the endless stream of economic forecasts. He firmly believes that in the long run, over 5, 10, or even 15 years, your portfolio's success will be determined not by market timing, but by the quality of the companies you own and their ability to consistently grow their earnings. Patience is paramount. Impulsive decisions based on short-term news are the enemy of good investing. He emphasizes that you should never invest money you might need within the next year, preventing you from being forced to sell at a loss during market downturns. Research is your secret weapon. While observing your surroundings is a great starting point, it's just that, a start. Lynch then guides you on how to dig deeper. This means looking at a company's financial statements, understanding key metrics, and, most importantly, grasping the company's story. What do they do? How do they make money? What are their competitive advantages? He demystifies financial jargon, making it accessible to the average person. Understanding stock categories. To help you analyze companies effectively, Lynch introduces 6 distinct categories of stocks. Each requires a slightly different approach. Slow growers. These are large, established companies with modest growth, often providing stable dividends. Stalwarts. Large, well-known companies like Coca-Cola, which grow at a moderate pace and offer stability. Fast growers. Smaller, dynamic companies with aggressive growth rates, 20 to 25% annually, often found in unexpected, non-glamorous industries. These are where many 10-baggers originate. Cyclicals. Companies whose performance ebbs and flows with the broader economy, such as automobile manufacturers or airlines. Timing is crucial with these. Turnarounds. Troubled companies on the brink of collapse, but with the potential for a dramatic recovery. These are high risk, high reward. Asset plays. Companies whose true value lies in undervalued assets, like real estate or patents, that aren't fully reflected in their stock price. What to avoid and why diversification matters, but not too much. Lynch offers clear warnings. Steer clear of hot stocks in hot industries, as they often become overvalued fads. He's also wary of companies that diversify too much, losing focus on their core business. Crucially, he advises against fixating solely on a stock's price. The underlying business is what truly matters, especially for companies without proven earnings. While diversification is good, don't overdo it. Owning a few good companies increases your chances of hitting a big winner. And remember, your potential losses are limited to your investment, but your gains are unlimited. That. Important considerations and conclusion. Approximately 3.5 minutes. Lynch also introduces the mirror test, a simple yet profound exercise. Look in the mirror and ask if you possess the qualities of a successful investor. Are you patient? Self-reliant? Do you have common sense? Can you resist panic during market downturns? These are often more important than advanced financial degrees. He echoes Warren Buffett's sentiment that the stock market doesn't exist in the sense of a mystical entity driving prices. Instead, it's simply a mechanism for buying and selling pieces of businesses. Your focus should always be on the underlying company, its health, and its future prospects, not the daily ticker. Finally, Lynch highlights a significant shift. The information advantage professionals once held has largely vanished. With the internet, individual investors now have access to a wealth of data. Analyst reports, company filings, news, and screening tools that was once exclusive. This levels the playing field, making the everyday investor's advantage of observing the world around them even more powerful when combined with accessible research. In summary, One Up on Wall Street isn't just a book about picking stocks. It's a manifesto for financial independence. It teaches that, with common sense, disciplined research, and a long-term perspective, you, the individual investor, can truly be one up on Wall Street and build significant wealth over time.